We've got a special jumbo edition of the FarrCast for you this week. Michael Farr has a double-link segment with our great friend, Dr. Jeffrey Lacker, former president of the Richmond Federal Reserve. But first up, Kenny Polcari on the markets, Dan Mahaffee on D.C. And now let's kick off the show with your host, Michael Farr.
Welcome to the FarrCast. I'm Michael Farr. Thanks so much for joining us this week. It is the 18th day of December. I woke up yesterday thinking, okay, December 17th. Oh yeah, it was my grandfather's birthday. My grandfather, Michael Gale, was born in 1901. And my grandfather, Michael Gale, was truly one of my heroes in life, was one of my best friends. I did everything with Pop. He taught me how to play golf. He was the best. He died when I was 17 and I was brokenhearted. Oh my goodness. But when I think about him over the years and smile, and by the way, 17 years old, that was a long time ago. Long time with that. And isn't it wonderful that people we even had for that much time stay with us? And he's been such a presence with me for all of those years. Kenny Polcari is coming up this morning. He's been a presence with me for, it feels almost like 100 years. He'll probably tell you that too. But both of them very good presences, and we will talk about what's going on in markets and everything. Okay, so quickly, folks, let's go through where we are. Markets are kind of slowing down, pulling back, pausing at the end of the year. The big drivers in the market, the big tech, the big heavy names, the big winners have been pulling back. Other stocks have been doing okay. Is this the beginning of this long-promised rotation back into value and a reallocation of assets and blah, blah, blah? I don't know. Nobody else knows. But we are seeing that bit of a pause before. We're seeing the pullback in the leadership. We've seen it a few times this year. It's happened a few times. Every time so far, it's been a pause and not a reversal. Therefore, this is still most likely to be a pause and not a reversal, but you don't know. They all look the same until one of them doesn't, right? So futures are back up this morning after a really tough day for stocks yesterday, a particularly hard day for NASDAQ, down 1.8%. NASDAQ futures are up 0.8% this morning, up 200 points. We'll see whether it holds for the day. 10-year Treasury, if you're going to talk to Polcari, to Urio, to Jim Lebenthal, to Jenny Harrington, any of our market folks, and we've got Jeff Lacker coming up, former president of the Richmond Federal Reserve Bank, they were going to tell you got to look at the 10-year Treasury. Look at all of the stock futures all you want. You want to find out what the real undercurrent is, whether the tide's going in or out, watch that 10-year Treasury. 414, that's rallied back from about a 420, 418, somewhere in there. We did get down to a 4%. That's coming back in the right direction. Oil is still nothing, $56 a barrel. Gold's been moving higher. Pay attention to gold. Pay attention. 43.54. Do we get back up to, we go to 4,400? Maybe. Inevitably, sooner or later, when you have this much debt and the only way to get out of it is to monetize it over time, you're going to see a higher price on all of that stuff, I believe. Euro right now is 117. The dollar, that's a tad stronger this morning, but in general, the dollar has gotten weaker over the balance of the year. All right. What will lead us into next year? Do we carry through? What do we do? Where are we going? Kenny Polcari is the chief market strategist for Slatestone Wealth, CEO at Case Advisors. Kenny Polcari, voice and face of Fox News. Welcome back to the FarrCast.
Michael, thanks for having me. I always enjoy your monologue, and today particularly I did enjoy it. It does feel like 150 years that you and I have been doing this together.
It really does. Do you remember the first time we were on TV together and I got your name wrong? Were we both on the floor, or you were on the floor? And
you had trouble pronouncing an Italian name. You just couldn't get it out of your mouth. You know what I mean?
Look, if you put all those vowels in the name and they leave them at the end, it's very confusing to an Irishman. So what are you going to do? So I got it. I figured it out over the years. And I've got a few nicknames for you, which I can't say on this program because children might be listening. All right, Polcari, is this a real rotation? Is this a pullback? Have we seen the end of the bull market? What happens through now and the end of the year? We got 2 weeks left, and then we've got 2026 coming.
No, So first, it's not the end of the bull market. Let's just push that out of the way. Is it a rotation? Sure, it's a rotation. It's a repricing of some risk. There is some concern now about this tech valuation. Look, I think it all goes down to, and we've been talking about it for weeks. It was a crowded trade. Everybody get in. Valuations got stretched. And now, there's some ongoing concerns about demand and how they're going to pay for this and on the debt side. And so there is a little bit of rotation out. I think it's healthy. I actually think it's good. It's going to kind of shake the branches a little bit. I don't think the theme and the trade is over by any stretch in terms of technology. It's going to continue to be the theme going forward in 26, 27, and 28. And I suspect actually, next year we're going to see it change even faster than we saw it change this year. And it changed pretty damn fast. Every time you turned around, there was more talk, new data, new ability, and all that. And I think that's going to continue to be the story. So yes, I think this is just part of rotation. I think it's window dressing at the end of the year. We've got 2 weeks to go, and there are two kind of holiday shortened weeks on top of it. And so you've got all these asset managers just doing end of the year window dressing. So when they send out the report cards and they send out their portfolios at the end of the year, everybody sees, oh, we're in all these names. And that's great. And, we've de-risked a little bit out of tech, but we still maintain the position. But now we're looking at, basic materials and industrials and more financials, areas that we've been talking about in this rotation. So no, I'm comfortable with it. What I said this morning in my note, these next 2 weeks are not a time to make an emotional decision, or in my opinion, an investment decision, unless you see a break either way significantly, right? A real break lower or a break higher. I think right now you just have to kind of wait it out. There's volumes are lower, moves are amplified.
All right. So you're not saying that this sort of a pullback where the leadership's taking a pause and the rest of the market's finding some more solid footing. You're not saying that this is some sort of a significant trend reversal. You think that the leadership will resume leadership and carry us through what? The first quarter, first half? How far through 2026 does that take us?
So I think the first half of 2026 is going to continue to be a little bit volatile because it is also the midterm election year. So there's going to be a lot going on just around politics, and the whole house is up for grabs, right? Every seat is up for grabs. And so there'll be some concern and chaos around that, which I think will then overflow into the markets. And as you and I both know, politics, while they create short-term chaos, doesn't necessarily price stocks in the long term. But that being said, I think you have to be prepared for that kind of rotation and that anxiety in the markets. But that being said, then I think as we get through tax season and people start getting their tax refunds, and you start to see what this big, beautiful bill is going to do, and you start to really see that GDP is going to ramp up next year, wages are going to continue to grow faster than inflation, that it all settles down into the markets, resume their uptrend. I think the AI theme and the tech theme will continue to be one of the top themes. But I think you have to think about an economy that's recovering like that. Industrials, basic materials, financials will all do well next year.
Let's take a look at AI for a second. George Will wrote a brilliant article yesterday, day before. I love George Will's columns. And I'm going to read something to you, Kenny, and see what you think. He says, The Economist says, quotes, if America's stock market crashes, it will be one of the most predicted financial implosions in history. Stocks are 21% of households' net worth, and AI-related assets are responsible for nearly half the increase in Americans' wealth over the past year. And, quotes, a fall in stocks comparable to the early 2000s dot-com bust would reduce Americans' households' net worth by 8%. That could cause a big retrenchment in consumer spending, end quotes. George Will says this will be messy, but bet on a net benefit from today's AI investment mania, which now accounts for 1.5% of GDP points. In 1969, one enormous, ubiquitous company, Sears, accounted for 1% of GDP. 1969, Kenny and I were 8 years old. And let me tell you, if we got to go to Sears, when we would get to go to Sears, that was seriously fun. Sears had everything. They had baseball mitts. They had sporting equipment. You and I went through this through the dot-coms. We saw these surges. We saw the huge investment. We saw the anticipation of what was going to happen when every American had a computer on their desk, and there was a concept of something you could actually take a computer around with you that we didn't believe, called a laptop. Oh my goodness, ladies and gentlemen, I'm not talking about the 1920s and horses going up and down pulling carriages here. I'm talking about 1996 and 1997. To have an individual computer on every desk in the office was still a big deal. So, Kenny, what do you think, and how do you invest around certain of these companies that will be absolutely disappear, and then find those that are sustainable, and then endure that inevitable sort of washback where it shows where we overspent?
Listen, I think you have to do that by trusting your advisor, having this conversation. The advisor is going to do the work, or you as a retail investor, you got to do your due diligence. You got to do your work. You got to pay attention to what's going on. And you have to avoid being FOMO-ized, right? You have to avoid feeling like you're always being left out or you're missing the trade. You're not missing the trade, right? It's just a matter of when you get in, how you get in, and how patient you are, and how you've done your homework. And you make sure that the reasons you get in, the fundamental reasons you get in, are the reasons you're staying in.
Yep. Why you get in keeps you in. You
Right.
don't have FOMO. And it's not only the fear of missing out. It's the fear of losing. It's the fear of staying in. It's that crushing sense when everything starts going down. Oh my God, I've really screwed this up. I've made a mistake. My judgment was wrong. I shouldn't have gotten into this stock market thing to start out with. I've got too much, and I should just sell and go to cash. No. Don't react to any of that.
Right.
If you know you're going to need cash, raise your cash now. Know that your cash is on the sideline. And when you look at your portfolio and say, yes, I'm fine if the market goes down 20%. No, look at your $2 million portfolio, take it down 20%, and walk around with that $1.6 million idea in your head. You can say 20%, but when I tell you 2 million is going to 1.6 million, I saw you just kind of sucking your breath for a second. I saw that sick look on your face.
You didn't see it on mine.
You got to get used to. No, because you don't have that much money, but people with wealth, Kenny, people with wealth.
You're right. I'm sorry. How stupid of me.
They worry about these things. But you know what I mean? It's the number. Don't talk about percentages. Hell, percentages are academic. Percentages are intellectual. Those dollars are real damn thing.
Correct. No, they are 100%. And that's always the problem, right? People are looking at the dollars, the change in the dollars. It's funny though, when the dollars change to the upside, everyone's patting themselves on the back, right? But when the dollars change on the downside, that's when people get, anxious and nervous. And I always keep telling you, as long as the portfolio, as long as you know what you own and why you own it, and the fundamental story has not changed, then it's just part of the cycle, right? And staying in the long term is going to be the biggest beneficiary.
I think that's a great place to end right there, except I've got to tell you, ladies and gentlemen, we are on video. Kenny is in his office. Kenny has a calculator on his desk that still has a paper tape on it. It still has a paper. This thing is the size of an old typewriter in the background on his desk. And okay, I'm going to confess, I just took mine and put it in my briefcase, and I bought this thing. Oh, hell, I bought it 30 some odd, almost 40 years ago, this calculator on my desk. Why? Because I used to trade bonds, and this thing would go to $100 million. You couldn't find calculators that went to $100 million in places. And I can run the thing.
I got to tell you, what's really funny is that calculator in the back that you see, when I do other videos, everybody comments, why do you have a calculator with paper?
I know.
Part of it is I've just had it for so long, it's just part of me. It's almost like, it's like a security blanket, right? It's just something I've had, and I'm not letting go of it.
I don't want to pull out my TI 865/42Z and punch in enter with the number and then punch in the function and punch in this. I want to hit friggin' divide. I want to figure out my percentages. I want to calculate my interest. I had a bond machine too. We'll talk about that on another show. Kenny Polcari.
You know what the best part about that is that the paper just keeps rolling, right? Every time you use it, the paper just keeps rolling and it curls up at the bottom underneath your desk. I think that's the best part. I enjoy that.
Merry Christmas and Happy New Year, Kenny. Coming up, everybody, Mahaffee. Please stay with us.
time now to go to our senior political analyst, Dan Mahaffee. And now here's your host, Michael Farr.
Welcome back to the FarrCast. Joining me now, as he does every week, and here we are in season 9, Dan Mahaffee, president of the Dr. Scholl Foundation, a scholar at the Center for the Study of the Presidency and Congress, and our senior political analyst on the FarrCast. Welcome back, Mr. Mahaffee, Professor.
Good morning, Michael. Thank you. Great as always to be here.
That was one of the great benefits of hanging out with your cousins. Dan would, and I would sort of start talking, and Dan would launch into something, and his cousins, who are of similar ages, their eyes would glaze over, and they just said, the professor does this, and there he goes again. Really, I mean, it was Ronald Reagan just dismissing Jimmy Carter. There he goes again, and it couldn't have cared less.
Yes, if only I could harness my cousins rolling their eyes at me as an alternative energy source. I'd be powering data centers.
No question about it. They're such lovely people, but boy, they were not interested in some of the same stuff you and I were talking about at dinner that night. Your mother was, and your aunt got very interested when we started talking about golf. Okay, ladies and gentlemen, we got to get to real stuff here. The president gave a speech last night. We're selling arms to Taiwan. Oh my goodness. ACA, we've got Republicans in the House defecting to vote, but will that be enough? We've got so much to cover here. Oh, and by the way, ready for ground troops in Venezuela? I don't believe it for a second. That just sounds like so much more rhetoric. And you got to wonder still why. I hear it's oil, but I mean, really, we're going to go down and take their oil? I mean, with the whole U.S. military force? Come on. Anyway, Mahaffee, where do you want to start?
Let's start with the president's speech last night. I think.
Yes, that was a good movie.
Yeah, and I think it was certainly one where you had the president trying to lay out his accomplishments as he sees them, a laundry list, as it were, of the things he's accomplished. And I think he wanted to focus mainly to his supporters, as well as those who got him elected, on the issues of the economy, clearly wanting more time, blaming so much of this on the Biden administration that you could be forgiven for thinking this was a campaign speech, not a White House address, but a lot about what he was saddled with from Biden. And unfortunately, I think for those who were hoping that the White House would want to somehow turn a page on some of the economic questions, not much of a plan ahead. So when you had a lot of this stuff too, and look, we got into crime, we got into immigration, we got into deportations. There was a lot of red meat in this that makes me wonder, perhaps in the White House, are they looking at the poll numbers and seeing some of their own supporters breaking? And that's why we're getting these reminders of, look at everything I've done better than Biden, and less of the rhetoric you would have seen if you were thinking, oh, he's trying to appeal to the moderate voter who's worried about making ends meet right now.
So, Dan, there was red meat there, but polls are showing that the president's approval ratings are slipping, and that there is some erosion among his MAGA base at this point that we haven't seen much before. Why are we seeing that? And when those folks are polled, what are they saying? We're not being political here now, folks. We're keeping our fingers on the pulse of perhaps what's going on as a change. And we've seen the president's popularity, every president's popularity, wax and wane, right? Wax and wane. So it wouldn't be unusual to see his start to flow a bit. But what do you say, Dan?
No, Michael, yes, you see the popularity wax and wane. And I think when you speak to his supporters, there's disappointment that you haven't had as much of the swamp cleared out, as it were, when it comes to things like Epstein or Comey or other things. There's the perception, too, that he's distracted on foreign policy. Is he more focused on the Middle East? Things like that. So you hear those complaints. But at the end of the day, it's the economy. It's affordability. It's those messages that the voter genuinely thought would significantly change. And look, we've seen inflation go down, but that's not what the voter has wanted. The voter has wanted prices to return to a pre-COVID state. And, economically, that's depression. You don't get deflation like that without depression. But ultimately, when the voter feels it in their pocketbook, no matter their affinity for the president or not, it's weighing on it. And look, this is the White House again finding themselves in the same problem, and we closed with it last week, the same issue the Biden administration had, which is how do you convince the voter that the economic metrics are better than what they're feeling each day when they go to the grocery store or check their bank account?
Yeah, it's very hard to do. So you basically are saying the president's message last night was somewhat of an orchestrated political message. Did you find any substance in what you heard?
I did not find much unless again, that he was trying to argue that his tariffs are, buying time for the economy, that he wants more time there to get these things done. That was the only message I heard, at least in terms of forward-looking policy, which is just give me a little more time to get this done. But I think particularly for the Republicans who are on the ballot next year, the members of Congress who will be facing the voters, I don't think that was enough of what they wanted to hear. And I think a lot of it, too, will come down to this administration wondering how do they get him back out on the campaign trail the next year, because they'll need to energize their voters if they want these Republicans to have any chance of retaining their seats.
Anecdotally, as I talk to uh, more right wing and still very conservative Republicans, they are supportive of the president's tariffs to the extent that they've raised a lot of money to reduce to pay down debt. With the president, they're telling me if the president starts to return those and not use them to pay down the debt, but then starts sending them out to Americans here and there for whatever reasons, they see that as something like vote purchasing or something. This is coming from MAGA Republicans.
Well, look, and he
Not as
did
supportive.
this. We saw some of this last night in his speech, and look, I don't have any qualms with anything to support our servicemen and women and the job they do. But this idea of sending out some kind of stipend to the troops, this 1776 stipend, $1,776. Look, these troops certainly earn it with what they do, but there's a lot of questions about the legality of that. And there's going to be a lot of politics around that. One, how do you pay for it? And two, uh, you know, is this political chess or checkers? Think of it whichever way you want. To blame the Supreme Court when it invalidates tariffs, as many feel it does, to blame the Supreme Court for taking this away.
Yeah, so we've started with the president's speech. We understand, I think, the politics at play currently. There is a division. This is a good intro, and let's go right to the House. There's a conflict in the House right now over the vote to extend ACA benefits the way they had been, the extra payments, etc. And there are some who may defect and vote with Democrats and with the more moderates and few moderate Republicans that are talking about doing that, even though that extension vote failed in the Senate. What's going on there? What does that mean, Dan?
Well, look, what it means on the policy side, we've talked about this, and there's really nothing new that moderate Republicans are feeling pressure from their constituents to extend, at least buy time to fix the Affordable Care Act subsidies, because so many folks are getting sticker shock opening their insurance bills. What this tells us, though, is that the anger with Speaker Johnson has boiled over. The discontent with members of Congress who have sat either back in their districts or relatively silenced when they were out of session during the government shutdown. That angered the rank and file. The issues a lot with how many of these things have been pushed top down by the House leadership, and a sense of frustration that many members have, frankly, that none of their priorities are really being moved on in a Congress that is, frankly, doing very little. And as you saw, if people watched last night or yesterday afternoon, excuse me, as Speaker Johnson was walking across the rotunda floor, he was asked, "Have you lost control of the House?" Straightforward. Anytime the speaker's answering, "No, I haven't lost control of the House," that's usually a sign he's lost control of the House. So the the questions he will be facing about the tenability of his leadership next year. The majority is not going to get any bigger anytime soon for him. And frankly, you're going to see a lot more of these discharge petitions unless they get some other way for the rank and file to have more of a voice. But it circles back to a lot of the challenges that the Republicans face within themselves, the policy differences they have that for now have been by and large, papered over by the president just kind of running over them.
What happens to the ACA and as the president says, it's the Unaffordability Act, healthcare unaffordability, So what happens there? Does this get extended or does this just continue to be a political
I see this being a
football?
political football that gets kicked around to the election. Unfortunately for people's finances, unless there's a real pressure point that someone breaks on here, but I don't see it. And look, there's different agreements in place that could prevail, short-term extensions. But right now, the incentive is just to use this to inflict pain on the other party rather than solve the problem for the constituents.
Okay. Well, there we are with a quick summation of politics today. Let's inflict pain on the populace, but maybe we'll get a few points on the other guys. That's the most frustrating part about Washington these days. Dan, finally, we're selling arms to Taiwan. China's upset. This is a big deal. Let's end here. I'm not sure. I am out of time. So give me 2 minutes, please. And we're going to have to get to Venezuela next week. And I assure you, folks, Venezuela will still have plenty for us to talk about next week.
Yeah, look, Michael, I think this is part of what we've seen for a while where despite the rhetoric that the president has of certainly wanting to soften or achieve a détente with Xi, that Taiwan support, Congress, others within the administration, that's sacrosanct, and that continuing to support Taiwan will be part of it because the United States nor any of the West, if you look at what we depend on Taiwan for, we cannot afford China changing the status quo by force. So we have to give Taiwan the support to defend itself. So you're going
to. I mean, at least China has to look up and say, wow, we're getting into something, another Russia, if the United States is at least doing what it did for Ukraine, there is a roadmap. Now, the Chinese, I think, probably are better strategists than Putin, and they've got that roadmap to figure a way around. So I don't begin to think.
Sure, and look, this gives Taiwan the ability to defend itself. At the end of the day, I'm still far more concerned that China would blockade, slowly encircle Taiwan and break it apart from within using fifth colonists rather than a wholesale invasion. But set that aside for another day. I think any reason the Chinese might pare back some of their protests are if I were in Beijing, I would be looking to the U.S. and saying, well, good luck making this all these weapons in time because you can't make them fast enough for yourself. Good luck, Taiwan.
Yeah, and good luck, Taiwan. We will continue to watch this and monitor this. And remember, ladies and gentlemen, Ukraine has some significant economic resources. Certainly, they're positioning strategically, but also in terms of grain. There are some rare earth metals, a number of other resources in Ukraine that have economic significance. Taiwan has a lot of economic significance, particularly in the world of chips. And Taiwan Semiconductor and a technology leader is a big, big, big economic deal that will affect markets more than Ukraine, in my opinion. So, and certainly if we go, it's one thing going head to head with Russia and their 140 some odd million people. It's another thing going head to head against China with their billion plus. That's a different game. So stay tuned, and we'll have Mahaffee back, and we're going to keep doing the FarrCast. And coming up is Dr. Jeffrey Lacker, former president of the Federal Reserve Bank of Richmond, and my great friend. Please stay with us.
Thanks for being with us this week. And now to introduce this week's special guest, it's your host, Michael Farr.
Welcome back to the FarrCast. I'm Michael Farr. It's the 18th day of December. We're 1 week from Christmas and a couple of weeks from New Year's. And that means a couple of weeks from 2026. I used to just say, I'm just getting used to writing 2025 on my checks, but really, who writes checks anymore? So I don't know when you have to write the date anymore. I wonder if young people know how to write checks. It's still kind of a fun thing to do from time to time. All right, Dr. Jeffrey Lacker coming up right now on the FarrCast. Drum roll, please. The man himself is here. He is the former president of the Federal Reserve Bank of Richmond, Virginia. And remember all of the other banks that would have come under his purview, all through the Charlotte banks, everything else. Think about the financial crisis, everything that this guy had to keep an eye on. Right now, he's the senior scholar at the Mercatus Center, and he's a member of the Shadow Open Market Committee. Most important to me, he's been a dear friend for 20 years. Jeff, welcome back to the FarrCast.
It's great to see you again, Michael. I'm glad you're in such good health and hearty spirits.
Thank you very much, sir. Thank you. My last day in the office at Farr Miller and Washington ever. I go back down to Florida tomorrow, and my last day at the firm is at the end of this year. It is very bittersweet, but I'm sure I'm going to cry when I walk out of this office for the last time today. I've been sitting at this desk a long time.
That's the hearty spirits.
Well, hearty spirits, yes. This is, we go on and we know that there are next things that will be wonderful,
Yes.
that will require me to learn and to grow and to discover. And, it doesn't all shut down unless you let it. And I'm pretty good shape. So we're going to keep rolling with this thing.
That's the best thing about retirement. You're going to love it.
I'm never going to do it. I don't think I've got
well, not
other companies
in the technical sense.
do and run.
Right.
Yes, the technical.
Right.
Yes.
Next phase. Yeah, you're going to love the next phase.
Exactly. Next quarter's up. All right. Jeff, how's the economy?
It's not bad. It's kind of struggling, but it's had a lot thrown at it. There's a big fall in the rate of growth of the labor supply. So the number of people who want to work in the United States isn't growing the way it did under the Biden administration a couple of years ago after pandemic. So the employment growth numbers look different than they used to. Inflation still.
Is that a normalization of the surge we saw under Biden?
Exactly. It's subtracting. Yeah, it's a reduction there was a big surge in immigration.
Yep.
Like 2 million a year it added to the labor force in 2022, 23. And then that fell off a cliff and, Biden tightened up in 2024. And this administration has kind of shut down. Net immigration is very, very small right now. So those workers come in, they buy things, but they also make things and provide services. So that's just a reduction in the growth of the economy. But, it's just a fact. And it's not that the economy is weak relative to supply. It's demand and supply are just both growing more slowly now this year than they were last year.
Okay.
So that's one thing.
Yep.
On top of that, you have inflation that the Fed hasn't gotten it back down to 2%. It's not happy with where it is now. The way the Fed measures it, it's 2.8. The CPI is going to come out, or maybe it did come out today.
Yeah, Jeff, actually, CPI, of course, out this morning, up 2.7% as an annualized rate. They were looking at, increasing somewhere around 3.1%. The core, stripping out food and energy, 2.6% over 12 months, a little kind of softer than expected. What does that mean?
Probably not much. I haven't dug into the details, so I don't know. But, it's measured by either the CPI or the Fed's favorite measure. It's close to 3%, and it's much closer to 3 than it is to 2. The Fed isn't satisfied with inflation where it is now, and it shouldn't be. It's elevated relative to its 2% target. The other thing you got going on in the economy now is a big surge in construction of facilities for data centers and to generate power to service those data centers. It's noteworthy. It's something that shows up in the GDP accounts as a notable surge in the second half of this year. So that's the other thing going on in the economy. Now, I don't think the labor market is soft. I think that you basically have supply and demand growing in balance. There's some noise from month to month. So the unemployment rate ticked up in November compared to September. Remember, in some of our economic data, we have a big hole in October when the
Yes.
shutdown occurred and people just weren't collecting certain parts of the data. But now November is kind of coming into view, and long old adage, don't make policy or draw conclusions from 1 month's data. But the general trend is that we've got a good labor market that's in balance. Firms are hesitant to hire because of policy uncertain, but they're hesitant to let people go either, because they had last time that happened, they went through that cycle. They had real trouble hiring skilled people back that knew what they were doing. So people are it's kind of a low hire, low fire. People talk about this environment, and so workers are a little nervous. It's a little tougher to search for a job these days. Technology for job search is changing. I think it's a reasonably good economy.
Okay, so you said a couple of things. The Fed, ladies and gentlemen, I was getting ready to tell Dr. Lacker. I caught myself. I was going to say, Jeff, the Fed has a dual mandate. Great. Ladies and gentlemen, the Fed has a dual mandate, which most of our listeners already know too, Dr. Lacker. But I've never actually, by the way, I've never bought into the Fed's dual mandate. Price stability should be the only mandate, in Farr's opinion, that the Fed has. I don't know how in the hell the Fed is supposed to control unemployment. I'd love your opinion, but I'd also like to say that if unemployment is below 5%, and if price stability isn't where it needs to be, why are they focusing on unemployment, which is considered fine at below 5%, and price stability isn't where it needs to be, and yet we're going to ease? Now, I don't understand what the Fed's doing.
That's a great question. First, about the dual mandate. I still subscribe to the formulation about that given by Paul Volcker and Alan Greenspan, who said that the best contribution the Fed can make to maximum employment, that's the phrase that's in the 1977 Act that people refer to when they talk about the dual mandate. The best contribution the Fed can make to maximum employment is to keep inflation low and stable. Because when inflation rises, the Fed has to bring down the hammer, and that is often causing causing a recession, and people are worse off. So it's better for the economy for the Fed to just focus on inflation. I used to say, this is in one of the FOMC transcripts, that Congress could give the Fed a mandate to maximize the number of times the Boston Red Sox win the World Series. But that doesn't mean the Fed's able to bring that about or should compromise its inflation target in order to do that. So I think the dual mandate, the way it's often thought of, is like a little trade-off. Do I want guns or butter? Do I want, pasta or fish? I mean, it's not a simple trade-off. That the economy doesn't work that way.
Charlie Plosser used to point out that there's a greater risk here involved that nobody talks about, which is and he blamed this on Greenspan. Charlie Plosser, I thought, was brilliant, and he was such a nice, gentle, funny guy whom I got to know, and sitting and having a cocktail with Charlie Plosser among my most favorite memories, anywhere, anytime, particularly when he would stop and look at me and say, do I have blood running from the corner of my mouth? Because I think I just bit my tongue in half because I almost answered your question, and I'm not about to. That's what he'd say, and I'm not about to. Charlie said, he blamed Greenspan for this, that the Fed overpromised this Yoda-esque ability, that it was a huge risk, a Greenspan risk that he added to the economy of allowing folks to think that the Fed can cure all of this stuff when in fact they can't help the Sox at all.
Yeah, well, I think it's debate. I'm more of a Yankees fan than a Red Sox fan. I think it's debatable whether they deserve any help from any institution of the federal government. But yeah, let me just say, dearly miss Charlie Plosser. I work with him on the Shadow Open Market Committee, and of course, we were on the Federal Open Market Committee together. He sat 2 seats. Cleveland was between Philadelphia and Richmond. He was the president of the Philadelphia Fed. And we had many and many interactions online, offline. And I dearly miss him, and I deeply, sad about his departure
Yes.
a few
Yes.
months ago.
What about the added risk he talked about, though? I mean,
Well, yeah, I think so. I think that Greenspan. So Volcker was of a mind of to just say what you're doing and shut up and let people
yes.
say whatever they want about it. He didn't care what people said about it. Greenspan was a little more attracted to the limelight, but still very much wanted to hold cards close to his vest so that he could do what he wanted later. He didn't want to be constrained by any past communications. And so that led him to deliberately obfuscate at times. And I think that allowed the rise of the belief that the Fed sort of worked the dials to manage a trade-off between inflation and unemployment. Now that trade-off's there at a very short horizon, like, the next quarter or two. But, at longer horizons, that trade-off vanishes and you just get more inflation with no more employment. He understood that very well, but I think he was just happy to let people read different things into his communications and move on and do what he
Yeah.
wanted.
Yeah. So you're saying the economy's fine,
Except for inflation. I mean, of course, that's
Yeah.
deeply unsatisfactory. So you wondered why, I didn't answer the second part of your question. You wondered why
Yes.
they're cutting, right?
Yes.
So, there's people with different philosophies about policy, and I think there's some people on the committee and a bunch of people outside the committee who feel as if the Fed should offset risks to employment, risks of employment falling rapidly, the unemployment rate rising rapidly, and tipping into the kind of spiral we get when we go into a recession, where layoffs in one industry, spark layoffs in other industries. People aren't absorbed in, the general churn of the labor market, and sort of overwhelms the labor market's ability to absorb people. People start holding back. There's some big shock to spending that leads us into a recession. So they see a risk of that, and that for them is trumping
but
the
Jeff,
fact that
that's-
actual inflation is 3%. So you've got actual inflation too high,
Yes.
employment fine, but they see risks, downside risks to employment. Now they don't see anything particular. They don't see a spark. They don't see a trigger. But the theory is that, if the economy is growing more slowly, there's more of a risk of that kind of spiral.
But the theory is that the Fed is supposed to be data dependent and not anticipatory about what happens around the next corner. They need to
I
see
agree.
the evidence, and they're okay. So Farr says they really should pay attention to the numbers. The old rule at the fish market: ignore the yelling and the screaming and pay attention to the price of fish, folks. And boy, is there a lot of yelling and screaming in Washington today. So let me keep going with this Fed thing, and then I want to shift to AI. And I'm already over time, Jeff. Believe it or not, I'm already over time. But this is too good.
Well, I'm sorry.
That's not your fault. This is fascinating. It's my fault because I just get so fascinated and I go down these rabbit holes and think these aren't even rabbit holes, but this is important stuff. Okay, people understand more when they listen to you. They really do. They learn stuff here. I know I learned stuff here.
What a great conversation with Dr. Jeff Lacker this week. As promised, it's a double-linked segment, but before we continue, I wanted to slip in a little bonus piece. Before we start taping a segment, I have the recording open while we chat, mostly just to set microphone levels, check for background noise, take technical mundane issues. But while we were getting ready, Dr. Lacker shared some insight into the history of the Fed decision-making that I thought was way more than mundane. So before we continue with the segment, here's a little history from Dr. Jeff Lacker.
I'm not like a central figure by any means, but I'm a peripheral.
You actually were a central figure, whether people knew it or not. You were a much more central figure.
You know who was?
Richmond Fed and the
really
banks.
Was? Charlie Plosser. We would not have the framework document without Charlie Plosser. With in,
So funny.
in 2002, Bernanke pushed through QE2, and he was afraid about inflation expectations getting out of control if they did QE again. And he wanted an announcement of an inflation target. And it failed because the doves at the board shot it down. So, but they do QE anyway. So Charlie goes to Ben and says, "Hey, this is really disappointing, you know." Bernanke was known for wanting an announced inflation target. He came in 2005, hadn't been able to get over the finish line in 10 years. So he said, "Here, let me take a crack at it. Me and a couple of presidents will draft something, and we'll see if we can get support for it." And he did that in the spring of 2011, drafted something, circulated among all the presidents, supported it, sent it up to Ben. Janet did some wordsmithing on it, and they got everyone but Tarullo to support it. And it was released in January 2012. It wouldn't have happened if Charlie hadn't gone to Ben and said, "Come on, let's get this done. This is ridiculous."
What's the benefit of having that target and having that target public?
So the reason we have the summary of economic projections is because they wanted to do it cheap, kind of on the sly. They said, "All right, let's have everyone submit their projections. And if everyone's projection for the inflation rate 2 years from now is the same, then that's our implicit target, right?" And that didn't work because some of us wanted a target of 1.5 or 1. So that didn't work. And so they said, "Well, let's try 3 years." That didn't work. So then they added this long run column. And that wasn't going to work either, they realized.
So they really needed it internally.
Right. Because I would go into a committee meeting and say, "Well, I think inflation should be 1.5. This is why I'm voting for this. This is why I'm resisting."
Got it.
So they needed like a common basis, So
that's cool.
Yeah.
That's good. I was always thinking I always thought that was part of the jawboning, part of the public steering and management of the message. It didn't occur to me they would have got it. Yeah, that makes
plus externally, I'm giving a speech and I say, I think inflation's too high. It should be 1.5.
Yeah.
Other people are saying so. Anyway, that was it.
Right. Okay.
I hope you found that as fascinating as I did. And now, back to the conversation and your host, Michael Farr.
The Fed, in response to the financial crisis of 2008 and 9, did a bunch of things they'd never done before, but they expanded their balance sheet. I don't know, from $500 billion maybe to $500 billion. I'm sorry.
It was about 1,000 billion. That's what it was.
It was 1,000 billion.
I got to get with this program here.
Yeah. So Farr doesn't like to say trillion anymore. I like to say 1,000 billion. Just so that you understand that when we say, we've got 2 trillion a year deficit spending. No. That's 2,000 billion. 2,000 billion is what is our deficit, is the money we're spending that we don't have. And tariffs are bringing in 236 billion. Great. I think you can understand the numbers better anyway. I can.
Yeah.
So
anyway, back to quantitative easing. So
$1 trillion.
The balance sheet was about $1 trillion.
Yep.
1,000 billion. And they were cutting interest rates in late 2008. They cut them all the way to essentially zero.
Yes.
Now, then the question arises, is the Fed capable of doing anything to ease economic conditions and stimulate the economy when they've already cut interest rates to zero? They can't cut them below zero because if they made the money market interest rates below zero, people would just buy all the $100 bills they could and stuff them in their mattresses or put them in safe deposit boxes, and companies would buy them up and put them in storage, and that would limit the downside they could go on interest rates. So to do something else, this has long been, central bank understanding of how central banks affect the economy. They can buy more assets, even with interest rates at zero. And the idea is that they're taking assets out of the public's hands and giving them money instead. And if people will want to buy other assets, they used to like holding those other assets. So they'll bid up the prices and bid down the rates of return on other assets. That's the theory, that a general rebalancing of portfolios will come into being. Now, what we learned when the Fed did this is that you had this big sector, the banking sector, that wanted to hold a lot of safe assets. And they hold them in the form of the liabilities of the Fed, the deposits at the Fed, plus they hold treasury securities, short-term treasury securities. The Fed bought treasury securities, increased the reserve balances that banks held, and the banks just sold off the treasury securities to the Fed, essentially. So it didn't have much effect at all. But the Fed felt compelled to do something. It didn't seem to be costly. It didn't seem like there was any downside. So the Fed did this a couple of times. There was QE1, QE2. There was another little thing in there too. The Fed bought securities and expanded its balance sheet. Then when it looked like the economy was okay, they started slowly selling off those securities they bought. But they stopped in 2019. And then in 2020, after the pandemic, they bought a lot more securities because that was the way to stimulate the economy when you cut the interest rate to zero. And then they turned around and they started selling those off. That was called quantitative tightening.
Yes.
But they stopped at the meeting before last.
Yes.
They stopped selling them off as of the end of November. And then in the middle of December, they decide to start buying again. And that's the thing I bet a lot of people are a bit puzzled about.
Well, so they've got $6.5 trillion on the Fed's balance sheet as opposed to that $1 trillion. So you were $1 trillion. Now GDP was smaller in 2008 and 2009, probably half, about where we are right now at $28 trillion GDP or something like that. We were probably half, I would think we were probably half GDP back then. And so instead of just doubling, my point is, we're not just doubling the $1 trillion in reserves they've had, we now have $6.5 trillion in reserves. This is a huge jump. And now they're adding to those reserves. Going to add a little bit here. Why?
So there's this deeply technical stuff that goes on in money markets. And when I say money markets, I mean the market for bank overnight loans to each other of reserve balances. That's one thing. Money market funds, people understand those. They hold short-term treasury securities. There are dealers in the government securities market that hold treasury securities of all types and have inventories, and they finance those in a market called the repo market. So those three markets, the repo market, among government securities dealers, the market for overnight Fed funds and the market for money funds who want to buy treasury securities, or CDs from banks. Those are all sort of interlocked. And then on top of all that, the Federal Reserve pays interest on its reserve account balances. Now, at the end of the day, you got reserve account balances. Any bank can make the interest rate on reserves the Fed pays. So any other interest rate is going to get compared to that interest rate on reserves. And so there's going to be an effect of the interest rate on reserves on other money market rates, like repo rates or the rates that money market funds pays. So that was like a quick overview of these markets.
Yeah, but I don't understand it any better after you just explained.
Well, so there's different interest rates. Like there's the interest rate they pay on reserves,
rates,
but there's slightly different interest rates. Like the repo rate is a little different than the interest rate on reserves, and the Fed
Why is
funds
the
rate.
Fed determined to manage these spreads, if you will, and control these rates so much? What's the big outcome? What's the effect on banks and the economy by it seems to me like they are, I'm going to use an expression that I stole from a favorite economist of mine, that they are over-mothering this economy.
That's a good description. That term goes back to William McChesney Martin, memo in 1952, when the Fed was freed up from the
Just so you don't think I'm that smart, ladies and gentlemen, I read this in a Lacquer interview from about a week or two ago. So, and I
Yeah.
loved it. Over
So
mothering, but yes,
so this is a deep kind of question. The Fed um, during World War II pegged government bond rates, kept them from rising to help finance the war, but they did that by printing a lot of money. And then the government had wage and price controls and rationing coupon books and stuff to keep inflation under control. After the war, in the Korean War, the Fed wanted out from under that, and they got the ability in 1951 to manage its own balance sheet. But it wanted a free market. It wanted to foster a free market in government securities. And now the U.S. Treasury market's deepest, most liquid financial market on the planet by a long measure. In
yes,
part because of the Fed encouraging a nice free market. But at the beginning, that phrase "mothering" is a concern that um, Martin had because the New York Fed, he got in a fight with the New York Fed, and the New York Fed wanted to intervene to help the Treasury finance new issues. They were, running a deficit for the Korean War, um, but they were unpredictable. They wanted to intervene at their discretion, and he was saying, well, if you're unpredictable, no one else is gonna come in and make a market. If you're gonna come in and kind of clobber the market from time to time in an unpredictable way. And the parallel here is that, we've got these big deficits coming. They continue to roll. What did you say? They were 2,000 billion, right?
yes,
Yeah, about 2,000 billion a year. And the Treasury is going to be coming to market. And there's always this risk that that fiscal outlook crinkles, gets a little fragile,
yeah.
and bond yields kind of spike up. So the Fed has set a precedent of intervening at times when market expectations shift and dealers back away from the market. And I think that could be tested in the coming years because people might be afraid that the Fed's just financing, monetizing the debt in a way that's going to cause inflation to rise.
And in the end, inflation still has to rise, doesn't it, with this much debt?
Doesn't have to. Doesn't really have to. But it depends on whether the demand is out there for U.S. Treasury securities. And if some political development leads to foreign investors, which are the big component of that, losing confidence in the United States, the rule of law, the sanctity of our markets, the integrity of our markets, that's the kind of thing that could shake confidence and jolt yields up.
Okay, so you're talking about a exogenous tipping point. Isn't there also an internal tipping point, an amount of debt, a percentage of GDP that's going to be that bang moment where people say, no. I mean, or don't we run a double risk by continuing to be deficit spenders and saying we can do this for the rest of history?
There's a risk out there that there is a point. No one knows where it is. It's not the same for every country. Japan had debt to GDP ratios much higher than ours, but if you sort through it out, it kind of looks reasonable and it worked out okay for them. So there's not going to be, a bright line that you cross and that's it. It all depends on the expectations of investors, particularly foreign investors that are going to have options in Europe and Japan and elsewhere, and their beliefs about what's going to govern U.S. fiscal and monetary policy in the years ahead.
Right. I want to move to one final thing on AI, and let's keep this really brief if we can. The productivity that's being caused by AI, the percentage of GDP growth the past year that's being driven by AI spending, a remarkable amount of AI spending is almost crowding out consumer spending. How long does this last? When have we seen periods like this before? I read George Will's column. He was talking about in the 1800s that railroad spending got to be 60% of GDP and that there was a lag, he points out in this particular column, saying, okay, there were railroads that went to nowhere, but once there was a railroad, a somewhere developed around it. It came up, the towns, the everything else, and the demand, and it expanded, and everything came a little bit later. He was quoting, I think, I quoted another article from The Economist, but it's a great point about how this spending, sometimes there's a lag in the actual productivity that shows up, or the expectation of productivity that shows up from the spend to the realization of data. Can you tell us a little bit about this? What are your concerns here? What are we getting wrong? Is there a bubble? Everybody thinks there's a bubble, Jeff. And can you do that in 2 minutes for me in really simple language?
Just take the word bubble, throw it in the trash can ahead of time. So innovations come along. I mean, a reflection on how your great grandparents lived, what their consumption bundle looked like, how they ate, how they provided for themselves, what they did with their lives, the technologies they used. And now, I mean, it's just so tremendously different. And the great enrichment that we've all benefited from the last 2 or 3 centuries of innovation and investment and growth has all been accompanied by mistakes, people guessing wrong, people guessing right, and people come in and ahead of time, who's to say whether it's a good investment or not? After the fact, some investments prove overblown, prove to go too far. After the fact, we call them bubbles, but that's neither here nor there. You got to know in the moment. Is this a good idea?
What are you seeing in this moment?
I think it looks like a reasonable prospect that it's going to be a powerful enough driver of economic change that these investments can monetize a decent return. Maybe not all of them. Maybe someone will go too far. Maybe someone will manage them poorly, and they'll be resorted. I'm reminded of 2 office buildings here in Richmond. I'm reminded of commercial real estate developers where there's enough demand for one office building, and 2 developers think that they've got the building project that's going to satisfy the demand. So they build them, and one of them turns out to be too soon. That happened here in Richmond in the 80s. So, this is just part of the churn, the gale of creative destruction that brings new innovations that improve our lives in measurable ways and have made us just so much wonderfully more well off than we were 3 centuries ago. So I'm willing to take the risk as an economy.
The gale of creative destruction.
Yes.
I'm going to have that. I'm going to have that tattooed somewhere. That's
credit Joseph Schumpeter, Austrian economist.
Pretty good. Yep. It rang a bell, and I was like, wait a minute. But God, it is what we're seeing, and there are companies that will fall by the wayside, but there are some that will excel, and they will be amazing. And really even beyond expectations, which is really exciting. It's an exciting, amazing time we're living in, economically, productivity-wise, and the way that our lives are going to be changed. And Jeff talked about the way our grandparents lived. They lived very well, but my grandparents didn't have air conditioning. They didn't have a television set for years. And boy, when they got a color television set, it took 3 people to carry it into the house. And it had about 4 channels. And it was amazing. It was amazing. So it does change. Productivity increases. And there are trade-offs. Jeff, thank you so much for being with us on the FarrCast. We always learn so much. And, underneath everything he said was, the economy's okay, folks. The economy's okay. We're not where we need to be with inflation, but we're okay. And certainly there's a lot of liquidity in the system. Certainly a lot. So
thank you, Michael, for having me on. Really enjoyed it.
You're the best. Please, we're going to have you back in 2026. I'm still going to be doing the FarrCast.
That's good. Give me a call.
That's it, ladies and gentlemen, for another FarrCast as we cover Wall Street, Washington, and the world. Harry Jennings and I have been doing this 9 years. Mahaffee, too, all of our other guests. We wish you and yours a very happy holiday season, Hanukkah, Christmas, whatever it is you're going to celebrate, we hope you do so in the arms of family and friends, and that this is a time that recharges, gives you a moment's pause and peace, and allows you to recuperate from the daily world of dull care. So we'll be back next week for a quick FarrCast Christmas and New Year's message, and that'll be it for me until the new year. So for Harry, everybody at Hightower, Farr, Miller, and Washington, thank you for listening. Thank you for being a part of the FarrCast. We have been named a top 100 podcast in the country, ladies and gentlemen. Top 100. We're very thrilled and very humbled, and we thank you, our listeners, for getting us there. In Washington, D.C., at the offices of Farr, Miller, and Washington for the very last time, I'm Michael Farr. I'll see you next week.
We hope you've enjoyed this jumbo edition of the FarrCast. Thanks to Michael's guest, Kenny Polcari, Dan Mahaffee, and special guest, Dr. Jeffrey Lacker. The FarrCast comes to you weekly and is produced by Michael Farr and Harry Jennings and is available for free on all major podcast platforms, including Apple Podcasts, Spotify, and TuneIn. We love hearing from you every week, and we try to respond to all of your notes and suggestions. You can reach us at hjennings@farrmiller.com. Let us know any questions you have and topics you'd like to hear us cover. We would like to remind you that the FarrCast podcast is for informational purposes only and should not be considered legal or financial advice. The information, statements, comments, views, and opinions expressed or provided in this podcast, including by speakers who are not officers, employees, or agents of Farr, Miller & Washington or Hightower Advisors, are not necessarily those of Farr, Miller & Washington, Hightower Advisors, or any firm any of our guests may represent. Any mention of a specific security should not be construed as a recommendation to buy or sell, and please be aware that past performance is not a guide to the future performance of any security, index, fund, manager, or strategy. We strongly recommend you review with a financial professional before you make any investment decision. And if we can be of assistance at Farr, Miller & Washington, please reach out to me at hjennings@farrmiller.com. We are here to help, and I'll be happy to put any of our listeners in touch with one of our investment professionals for a complimentary review of your portfolio and your investment goals. Take care, stay safe, and stay healthy. We're scheduled to be with you the day after Christmas next week with a quick catch-up with our friend Jim Lebenthal. Go beyond the headlines each week with the FarrCast. Wall Street, Washington, and the world. Farr, Miller & Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors. Securities are offered through Hightower Securities. All information referenced herein is from sources believed to be reliable. Farr, Miller & Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr, Miller & Washington and Hightower Advisors, LLC, nor any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions, or results obtained from the use of this information. Farr, Miller & Washington and Hightower Advisors or any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented to any entity as tax or legal advice. Clients are urged to consult their tax and/or legal advisor for related questions.